Okay, we'll go ahead. It's 1:01. We'll go ahead and get started. Good afternoon, everyone. I'm Barb Shannon. I'm Vice President of Sales for CoWorx Staffing. My colleague is Shannon Stedman, and she's the Director of Sales for New England. Welcome to our webinar today, The State of the State, Insights on Today's Labor Market. As HR and manufacturing professionals, we all know firsthand the challenges of attracting talent, retaining them, managing them, and also all of the changes from the demographic shifts, participation rates, employment participation rates, evolving workforce expectations, and the ongoing skills gap. The employment landscape, needless to say, can be very challenging. To help us better understand these dynamics, we're fortunate to be joined by the nation's leading labor economist, Ron Hetrick. Ron brings decades of expertise in analyzing employment data, workforce demographics, and economic forces shaping labor supply and demand. He's a frequent speaker and a trusted voice on workforce issues. He's known for making complex data not only clear, and I can attest to this, but actionable for business leaders. Today, Ron will walk us through where the U.S. labor market stands now, what's driving the challenges we're facing, and what lies ahead. Please join me in welcoming Ron.
I think that I'd have these controls down. All right, well, thanks everybody for showing up today. If you follow me on LinkedIn, you know I stick little things out there every now and then to try to just, kind of poke the bear a little bit, make sure everybody's clear on what's happening. I really feel that it's the most important thing we can do in society is give people, kind of the basis, the truth, that they can then form their own opinions and decide what they're going to do based on what's really happening out there. So what you're going to get today is my view of what's happening in this labor economy. As was said, I've been doing this for 33 years. I started off at the Bureau of Labor Statistics and oversaw the payroll survey for my time there. And I've just been, writing and going around the country speaking on the state of our labor market for years now. And here's kind of my take on where we're at. Okay, so basically the goal of what we're going to talk about today is I want to talk about what keeps the economy moving, and because that's going to be a critical aspect of what's going on with the labor situation. And then we're going to talk about what is the state of labor currently. How do we kind of see everything that's happening right now? There have been so many headlines. There are so many things going out, so many policy things happening. But what is the underlying state of the labor economy? And then next, what do we need to know about what's coming in the next several quarters? How do we feel about what's coming up? And really with this, if we understand everything that's happening right now, it kind of, everybody becomes an economist at that point. You start to say, well, if that's true, if that's what's driving this, then if that changes, this will change as well. And then last, we're going to take a look at some sectors. We're going to be looking at light industrial and professional and IT, and really not to go into every sector, but just kind of talk about where they're all at and why there's kind of a symbiotic relationship between everything that's happening out there. So when one piece moves, the others will move. There's very unlikely that things will move separately from each other, but I want to make sure that I explain that as well as I possibly can. So here's the current situation. Here's what we're watching. Here's what I am watching on a weekly basis, or what I'm constantly looking at to see where we're at in this economy. Number one, we're looking at unemployment claims. So we've seen they've been kind of rising, but we're still dealing with almost historical low levels. We'll have a slide on that. Our unemployment rate has been holding in the low 4% range, which historically speaking is very low. Our labor force participation is not recovering, and it's actually could get a little bit worse. I'll try to explain that, even though that's not going to be the primary focus of today's conversation. These next 2 points are very, very important. If you've ever read Demographic Drought, the research that I've done, Demographic Drought, Who's Going to Do the Work, and The Rising Storm, you'll know that this is a central topic of that, and that is the high school only labor force has grown by 200,000 since prior to the pandemic, but the college degree labor force has grown by 6.7 million. If we go back to 2010, the high school only labor force has declined by 1.5 million, while our bachelor's degree labor force has increased by an astounding 21 million. So this is really important to understand. What we have in our economy, the labor force that we have, the labor force we keep bringing in is a very, very educated labor force. It is not one that typically doesn't have a high school diploma. You will find out very quickly why I'm stressing these points. Lastly, the housing market is still overinflated, despite we've seen some increase in listings. We've seen some cutbacks in pricing. but it is still not at a level that would be a kind of a healthy level, which would allow mobility and people to kind of really start to re-energize that market. And I think when we look at housing sales, they're very weak historically speaking. So even though they picked up a little bit, they're really not that great when we go back in time. Everybody knows this next point. It's something I will talk about today. I'll talk about it towards the end. Tariffs create an uncertain factor. The ultimate effects of them, how much money they raise, all of these other things are inconsequential. What we're concerned about is this is a labor market. How is this affecting our labor market? And with tariffs, what it does is it introduces uncertainty, and people don't like to hire in uncertain times. It's a very unpopular thing for your shareholders to say, hey, we're going to do a big hiring thing right now. And the shareholders are going, why? Are you anticipating an increased demand? All of those things kind of play into it. Wage inflation, which I'll show you for a certain sector, is actually been returning down to a more normal level of growth. You don't want it to necessarily go into a decline, but we would like to see it calmer. And then lastly, we have something that I'll be talking about a little bit, and that is we have AI, which is being blamed for the middling performance of the job market, especially in entry professional. But I'm going to try to do my best to explain that I think that's just a matter of circumstances, and hopefully that will come out, but it's just an attempt to try to explain it. I'm not definitively saying something here. So let's do this. First thing, we got GDP, and as you heard, GDP in the second quarter ended up being a little bit better than I originally thought. But what we've been seeing here is ever since the pandemic, GDP is really not producing at a level that it was prior to the pandemic. If you've read The Rising Storm, one of the things you probably know is that I'm constantly talking about we are not at a level of employment that it will match where we've been in the past. We have gone through a structural change. The labor force participation rate is much lower than it has ever been, and it's not recovering. It's actually getting a little worse. So we are not performing at a level that we should, but it's not because it's a weak economy per se, but just a matter of GDP is driven by consumption. And people are spending money, which we will see in just a second. However, less people spending money is a problem. So you could have people out there spending and spending, but you really want as many people as possible to be in that high consumption category. And retirees don't fit that particular demographic. And that's what we really are creating a lot of in this country right now. So it's kind of affecting the way that we're growing and will grow into the future. The unemployment rate nationally is around 4.3%, and it's been kind of stuck in this range of the about the low 4% range. What I like to show people on this graph is that if we look at like a 4.3% range and you go back in time, I want you to see that at least since 2000, this is an incredibly low rate. You know, even though we bottomed out around 3.233 and we've gone up into the low fours, you know, that is not indicative of a weak market. It's not even close. That's only indicative of weak versus where we've been the past couple of years since 2018, 2019. But historically speaking, or at least in the past 25 years, this is still a really great number, relatively speaking. I think a lot of people, that's one of the things that I talk about a lot is we have recency bias. We have a tendency to look at things very recently when the unemployment rate was very low. And now we look at this economy and go, it stinks. The reality is it doesn't stink historically speaking. It stinks recently speaking. And that is a factor, but it's something we have to keep in perspective. If we look at unemployment claims, so several years ago, the Fed wants to cool off wage inflation. They're trying to get everything to kind of cool off a little bit. They start raising interest rates. Their hope in doing that is to increase the amount of available labor so that if there's a much larger pool of workers, then that will mean less of a need for employers to raise wages because they're going to be able to attract these workers. So the net result of several years of these increases in interest rates is that we really haven't done anything. So the available labor pool, if we think about people actually collecting unemployment claims, so these are people who have to prove that they were out looking for a job. Now, not everybody can do that. If you were out of the labor force and came back in, you obviously can't file for unemployment. But this number is something that we're watching because it's really incredibly low. So if we go back to 1974, we actually have the amount of people collecting unemployment in this country right now is the same as it was in 1974. That's how far back we had to go in time just to find the number of people collecting. And yet we've grown, our labor force has grown 86% since then. So I just need you to understand that as a percentage of our total labor force, This is such an insanely low number. And it's something that Chairman Powell keeps looking at when they're talking about interest rates and they're talking about what they want to do and they're looking at a propensity for inflation. One of the things they're looking at here is this number, and they're going, wow, we really haven't been able to do anything. We really haven't been able to really weaken this economy. What's happening is a lot of people, if they've lost their jobs, are just going ahead and retiring, or they're going to the sideline, or they're just kind of going in and out of the labor force. But there's some other factors here which we will also hit on as well. So let's dig into GDP a little bit more. So I talked about this earlier. Real personal consumption expenditures. People are spending money. We do not see a collapse in any part of this. That is the biggest part of our economy, are people out there buying goods. So we want to make sure that people are spending, and people will spend if they have a job. So that's why when we look at things and you start calling recessions, we're always looking for that bind between GDP and unemployment. So when you're looking at, well, we need these consecutive quarters of negative GDP, but we're also looking for, is the labor market falling apart? Because if the labor market is still doing well, then that means that many people have jobs. And if you have a job, then you're going to be spending money. If you start to lose jobs, or if we have more uncertainty, people will tighten that spend in. And we're really not seeing a constriction of spend from the household side. When we look at the company side, are they investing? And the reality is they are. It's not as strong as it used to be, but it is doing okay. It's doing well right now overall in private domestic investment. Advanced retail sales are yet another indicator. What happens is, in some people's zest to call recessions or do things, what they'll do is they'll find one of these little down point movements that we see on this graph, and they'll go, see, retail sales are not doing well. And then the thing bounces back the very next month. There is no collapse here. There is an inflation aspect that goes into this. This isn't done in real dollars. We're not deflating these things. However, if there's true weakness, even despite inflation, you'll see these numbers go down. That's just the way things work. And yet we're not seeing that. So people kind of holding and they're buying and they're doing these things. So if people are spending, that's a great fundamental aspect to say that manufacturers are moving goods, warehouses are moving goods. Different companies that service those chains are also probably going to be doing well as well. So let's start to separate this labor force, and we're going to look at it in two buckets. The first bucket will be the non-degree labor force, and then the second bucket will have to deal with the degree labor force. So I've already mentioned earlier that we have a very big problem that we really aren't seeing any growth in our non-degree labor force. So this shows up here. So this is the unemployment rate for people who are in production occupations. And as you can see, that the unemployment rate in this is also hovering at its all-time historical low. So outside of certain wars like World War II, we've never seen rates this low except in very recent history. There are about 1.1 million people in this country who say their last job was in production or warehousing or logistics. It's in the range of the lowest numbers we've ever seen in recorded history. About 1 in 14 job seekers are looking in manufacturing. So this is one issue of, if we wanted to grow manufacturing, and it's something I've been talking about more recently, is let's say we wanted to reshore manufacturing. The reality is we just don't have those people anymore. And the thing about this number is you take that 1.1 million, well, you spread that across the entire United States. So what's the numbers in any given area of actively looking people looking to take a job in manufacturing? And the answer is it's profoundly small. So for manufacturing to grow, it would have to steal from other industries that are related. So warehousing, construction, retail, eating and drinking, things like that, because we really just don't have that base of people anymore. When we're looking at things like maintenance techs, these installation maintenance and repair techs, also hovering around historical lows, up a little bit recently, but you have to understand these are lows that are basically at the same level that IT would be. So a lot of people always kind of looked at IT as having some of the lowest unemployment rates outside of healthcare. Well, maintenance techs are also in that particular bucket. It's why it's so hard to find those kind of people. When we look at manufacturing, core new orders, so this is stripping out things like aircraft and tanks and things like that. Core new orders have been doing fine. They had a little dip. They've been coming up recently. Manufacturing shipments also holding at their very, very high level. Once again, inflation helped them get to that high level. But what we're looking at is, are they maintaining that level? Because if you go back in time, you can always see these things drop during recessions, but we're not dropping. So it's no indication here that we're about to go into anything. It looks fine. It's not fantastic, but it's not weak. It's just simply holding where it's at. If we look at companies who are actually buying industrial equipment, now I'm sure this is being helped a lot by AI in certain parts, we do see incredible growth in this particular category. So people are buying equipment. So that's a big thing. Those are larger purchase goods for manufacturing. It typically goes into other manufactured goods. So this is always a sign that we use as well to see if the economy is starting to fall apart. You go back through the shaded areas during recessions, these things always fall apart. This time, they're not doing that. They're actually going the opposite. They're really exploding. This would tend to suggest that we're about to go through an expansion, not a retraction, looking at this particular part. I talked about wage inflation. This is year-over-year changes in wages for production and transportation and material moving. So warehouse workers and light industrial workers. And you can see that it did get crazy, obviously, back in 21. Kind of went up and down. We see this last spike that we had in kind of mid-24, and now it's come way, way down since then. This is obviously a big thing of what the Fed's looking at, because this was one of the big pushes for why we had inflation. We had a very serious wage price spiral occurring when we had this kind of shortage of workers in these industries in 20 and 21. That's why prices shot up. And now we're seeing numbers that kind of indicate that we've hit more of an equilibrium. So you can kind of go to the right side. I work for Lightcast. We're a labor data company. These are advertised wages in these occupations. You can see they were very steadily going up. But if you look recently, those numbers have come down a little bit. So that helps us to understand that the balance of supply and demand is probably in a very good state right now. And we'll keep a close eye on that. But there is a huge factor here we have to take into account. So back when we were having this profound labor shortage, job openings in manufacturing got up to about 1 million. Now, since that, they've come down to a much more reasonable level. In fact, they're now at a level that is right around where they were prior to the pandemic. So we know that manufacturing employment's actually fallen by 167,000 since 2022. And we know that job openings have gone way down. So is this because the industry is weak, or was something else explaining everything that was happening in this? And the answer is, it's probably the fact that these things were being filled, but not in a way that we would typically have watched. So we know that there was a massive expansion of countries that were given asylum seeking status, that these people came in, they did their initial waiting period. They then went into the queue to wait for their visas to be passed. Now, while you're in that queue, you're still technically considered an undocumented immigrant, an illegal immigrant. However, you are cleared to work and you're basically in process. But we had about 5 million people that were in the line for visas. So these people are going to be in these lines for years. So we kind of use those people to fill these jobs. So if you go to the bottom, right now in this country, we have 558,000 people who are unemployed, who were last in manufacturing. That's an unemployment rate of a very low 3.8%. However, we have about 850,000 undocumented immigrants who work in manufacturing. So these would largely be these asylum seekers. So if we were to send them all home tomorrow, you would have a negative 300,000, which means the manufacturing industry would be starved of about 300,000 workers. So this is why we have to understand that there is, when you start to see numbers coming down, or if we even see manufacturing employment falling, it may not necessarily be for reasons historically that we think, which is, well, their demand must be going down. I just showed you on the previous slides, that's not true at all. Shipments have been doing very, very well. New orders have been doing very, very well. It's not that those conditions changed. It's just the labor force that they acquired and are now losing are kind of affecting their numbers. So I just want to make sure that part is clear, because I think there's a lot of confusion right now out there, because we're kind of used to looking at things before we've had this structural change that occurred in our economy. So this is what I was talking about. These are the amount of asylum seekers that came into our country. I'm sorry, these are undocumented immigrants, but I want you to see anything under the white line there are people that were seeking asylum. So you have about 2 million people that came in 22 and 23. Well, if you start to work your way back, we had about 1 million job openings in manufacturing back in 22. Watch all those numbers start coming down dramatically right as these numbers start coming up. So this is something that we do understand, this relationship. It affected construction, it affected manufacturing, and it affected hospitality. So hotels and restaurants, all at a very profound level. And that's why we see these things kind of changing. So once again, if you reverse these numbers, if you were to send these people back, then you would actually reverse this situation that we see here in the prior slide. Now, when you look at the percentage of an occupation that is filled by immigrants, so you can get to some that are pretty amazing. So it's say you're building, your grounds cleaning, your maintenance workers. 40% of those people in our country right now are immigrants. So it's not necessarily undocumented, but just immigrants, foreign-born workers in general. If you go down there, about 5 more, you get production workers, about 1 out of every 5. In warehousing, it's about 1 out of every 4 for production, 1 out of every 5 for warehousing. And then down to install, maintenance, and repair, down a little bit farther, also just shy of about 1 out of every 5. So we do understand that there has just been a very significant change in how we were filling these types of jobs. We understand that that's how these things were affecting manufacturing, some other industries. So when we watch these trends happening in immigration, we kind of look at those industries and see, well, what's happening right now? I noticed that manufacturing did tick up. Their job openings did tick up last month in the numbers that just came out. So we do know that there's a big significant change. Obviously, we have revoked asylee status to a lot of countries, and we kind of clamped down on these things. So our border encounters that had been really, really high in 22 and 23 tapered off about mid-2024, and now they just basically don't exist in 2025. So we know that there's going to be a very, very serious constriction of that labor supply. There are some projections that it could be a negative change this year. As far as literally going into the negative, the amount of people that kind of exit out. So this is going to be something we want to watch as things go on. And this is a very significant factor for us as an economy because we've grown very dependent on this labor force. In some industries, they've gotten all of their growth through foreign-born workers. So mining, the tech industry, and then retail trade has seen all of their growth occurring through foreign-born workers, not through the native-born population. And then for the others, you see these percentages that are very, very high. Now, granted, you're dealing with a smaller number, so your percentages are going to be bigger. However, you can see that we do see significant dependency changes through 2023. So knowing what's going on in 2024 and knowing that this was where a lot of industries were getting their growth from, it just helps us to kind of understand what we're looking at in the next several quarters as far as the labor market's concerned. I've already told you we are dealing with near record level lows of unemployment claims, that we already have a fairly low unemployment rate. There's not a lot of an available workforce out there. And this labor force, which did come in and kind of mitigate our wage inflation in 22 and 23, is now probably going to reverse. So this is something we want to watch through the end of this year and going into next year. So the key takeaway here is that if you need a young person, people with strong physical capabilities, then we know that that market is incredibly tight. I just spoke yesterday in another part of the country, and several manufacturing companies came up to me and they're like, wow, we're feeling this in a big way right now. Just really, really difficult to find workers at this particular time. And it's like, and trying to explain, well, this is probably why you're seeing this particular things, is I think it's just important to understand that. So with that in mind, let's switch to the professional side. So lately, we've been in something that I kind of started calling the white collar malaise about a year ago. And that is we're just not seeing a lot of excitement in the professional market. So if we look at job postings in business and professional occupations, you can see that they took quite a hit coming off of 22, fell through 23. And then since kind of late 23 up to where we are now, they're stuck. They haven't kept going down. They've just been stuck at this level. And these are very low levels when we go back through history. So we have both postings that are not doing well, and then we look at the unemployment rate, which has been creeping up recently. It's once again not horrible. It's not a terrible unemployment rate. It's actually around 3% for professional. That's not a terrible number. It's certainly not a very high number to suggest a recession. However, it's definitely enough stuck where it's been to make people feel like things are really not doing well. However, it's kind of a jury still kind of out thing. One of the things we look at here is, well, what about recruiters? Or people will start to show if they're going to hire if they start hiring recruiters. And we can see that that's not happening. We've seen a very flat line for recruiter postings since early 2023. So we're not seeing anything yet to indicate people are ready to jump in, but that wouldn't make any sense anyway, because we still are dealing with the tariff situation. There's still uncertainty about where we're going to go as an economy, kind of what's there, what's coming next. So we don't expect this to pick up yet. This is just kind of confirmation that people are holding steady. One of the things that we're going to see even in IT is that when you see an unemployment rate like this, and it's kind of middling and not doing well, and you see postings that aren't doing very well, you start to say, well, are things really, what is the real situation? So an unemployment rate is a calculation between employed and unemployed workers as part of a labor force. And this is something we have to understand. The population, the number of people that are employed as business and finance professionals has actually been growing almost this entire time. So while we've been saying that this is a terrible market for professionals, the reality is the number of people who are employed in these professionals has been growing this entire time. Once again, it's not indicative of a recession. It's not indicative of anything. It's just been an odd time where things aren't happening like they were prior, but they're still happening. We're still moving upward. We're just doing it at a very slow pace that makes people a little uncomfortable. They're not able to get the pay increases that they saw in 21 and 22. I think a lot of people who took those jobs were hoping they could get out of those jobs maybe in the past 2 years, but this is not the market. As you can see with these postings, the past couple of years, this is not the market to do that. So you're kind of stuck where you are right now, and that makes people get a bit frustrated. One of the big things that's happening is you look at the banking industry. This is a great industry to give us a clue as to what's happening in the professional market. So right after the pandemic, we saw this massive surge in hiring in banking. So the employment levels in banking just skyrocketed very unnaturally during this particular time. If we go to the bottom right, we can see why. That's because we had an explosion in our housing market. We had given a lot of money out. There was a lot of wealth at that particular time and a lot of expansion of people buying secondary properties as short-term rentals because there was a concern about inflation. And when that happens, people leave the stock market, and they use that money instead to buy properties, which are a better hedge bet against inflation than the stock market is. So that's what kind of happened during this particular time. Well, then prices got outrageous, everything kind of settled down, and then no one was buying anything. If people were buying homes, they were basically using cash. So banking took a massive, massive hit. So they've lost 135,000 jobs since their peak in 2021. And you can see what's happened. And you are actually talking about mortgage originations occurring now at levels almost we've never seen. These are some of the lowest levels that we've ever seen. And most of the mortgages that are going out are only going out to people with very, very high ratings. So these are super prime mortgages. They're certainly not going out to people at the lower end. And that is something that is a big deal as far as mortgage originations are concerned. Now, let's talk about IT. So the last sector I want to talk about. Now, you're going to see a very similar path here between professional and IT. Now, so back in 21 and 22, you have this kind of initial explosion in AI. These are when companies were first starting to explore these things, and we get a lot of action. The private equity market was really going hardcore into IT at this time. A lot of new things happening, and you see this kind of explosive growth, people quitting their jobs, getting $20,000, $30,000 pay increases left and right. Well, that market is long gone. That market is done. So if we look at the number of unemployed IT workers down here at the bottom left, you're going to see that that has really been jumping. In fact, outside of a recession, we've never seen that many unemployed IT workers. However, if you go to the right side, you see the IT unemployment rate, and that actually is not bad at all. It's actually it's doing pretty well historically speaking. Yes, it's up from its low in 2022, like everything else is, but historically speaking, it's really not that bad. So what does that tell you? It tells you that we've had a ton of people going into IT. So what you see at the top is since 2015, we've seen a 54% increase in people who are going into IT. So lately, I'm sure you've been hearing about this whole H-1B thing, and we're going to charge a lot more for H-1Bs. One of the reasons that this is happening is because the U.S. is now producing a lot of IT workers. We've sent an enormous amount of people to college, told them to become coders, and they did. So we're kind of flooding the market with these people now, and the opportunities aren't there. If you can see in the past couple of years, they aren't really happening like they were. And there's another reason for that we'll explain. But I just want you to understand that this is one of the things kind of driving this is maybe the H-1B program is kind of getting a little past its peak. I want you to show these real quick, and that is a lot of these IT industries have frozen. In some cases, they're declining a little bit, but for the most part, they're holding. This is because of what I was talking about earlier. Back in 21 and 22, a lot of private equity money funded these companies, funded these startups. When they stopped doing that, and you can see that in the bottom right there, that graph, when they stopped doing that, we see a significant relationship between the drop in venture capital funding for these particular kind of companies and this particular drop in postings that we see here on the top left. So postings go down when the funding goes away. So we are also already starting to see a big change. So this is employment in semiconductors, which has been on a nosedive for about 1.5 years. And then power gen equipment, which was another big factor of kind of going behind AI infrastructure, also kind of struggling. The concern here, and this is going to be my last major point, is that AI is kind of driving a lot of the market. So it's driving a lot of the money going through the market. It's driving a lot of our investment. However, it's not really doing anything. So everything is grossly overvalued. These companies can't exit. The ones who are bought by private equity are having problems. They can't really sell them because they're very overvalued. So just this past month, Sam Altman was saying, and chairman of OpenAI is like, look, we're in a bubble and this thing's going to melt down. And we have a lot of companies looking at it going, there's really not much money in it. So there may be revenue, but everybody who's doing it isn't really making profits. So when we look at this, we kind of go, this could explode. Like this could pop right in front of our eyes. And the reason why is it's been very hard for people to do something that's innovative because they're all using the same platform. So if I come up with a new idea, somebody else comes up with it too. There's been a diminishing avenues to make revenue. We may be able to make something that allows us to let go of an employee, but that's not revenue. That's just saving kind of profitability. And you can kind of go down through these. OpenAI's lost $5 billion last year, projected to lose $9 billion this year. Anthropic's the other big one, projected to lose about $3 billion this year. We are very concerned about what this could do to the labor market if this thing pops. So this is kind of one of those clouds that we want to look at. Right now, I will just say this, and that is, and I've been kind of making this point, do not confuse this economy, which is in a lot of uncertainty, with AI stealing jobs, because what you're seeing is companies are taking money that they would have paid employees and they're using it to invest in AI. So it's not that AI necessarily took the job, it's that they spent a lot of money on AI and they need to make up the money they spent by getting rid of people. Every time I see an announcement by a company that says, we just got rid of people and replaced it with AI, I immediately go in and look at their financials and I see that their capital expenditures have been going up dramatically, which means they had to balance their books somehow. And that's coming from basically saying, well, we cut people because of AI, because you're not going to get punished for that by your investors as well as from other things. I'm not going to talk about this, only just say that people think robots are coming, but robot investments in this country have actually been very, very mild in the past several years. Collaborative robotics, which would be that kind of next level robots, have actually been declining. So we're not really seeing the robot army kind of coming right now. That'll be an interesting thing to watch over the next couple years as well. So this is my last slide, and that is, where do I see things going? I'm still very, very, very concerned that if this economy tried to take off, there is not a labor supply below $25 an hour of any depth whatsoever. We could drain that thing immediately and end up right back in a price competition, which is exactly what the Fed is thinking as well. And then from the professional side, we have a lot of sectors that are in a funk. They need some consistent good news. You need stability in tariffs, and you need the Fed to say, we're going to keep lowering interest rates to get people thinking, I may want to start hiring again. Until you get that, we're going to be stuck where we've been the past couple of years. Really not going to go into this. I've kind of talked about a lot of those things. So I want to make sure we left some time for questions. I didn't leave as much time as I wanted, but I hit you with so much and your heads are probably swimming. Just in case, here's my contact stuff. Go ahead, fire away any questions you may have from what we talked about or anything I may not have talked about.
Sure, Ron. So we do have a Q&A section, everybody. So if you have any questions for Ron, please feel free to go to the Q&A or the chat and put your question in there. And right now we have one. You did make reference to this already, Ron, but any further comments? The question is, how do you think the new executive order to charge an application fee for the H-1B visa applicants further affect our current labor pool?
Yeah, this is something where it's been interesting to watch because the details are what's really critical here. What they're looking at is we want to divide these people into buckets. If they're really stellar, if they're blowing everything away, if this is truly the top talent in the world, then you're going to be willing to pay that fee. You're going to do that because you recognize you're bringing in the best, the very best in the world. And what they're saying is after that, start learning how to train people here. So this in a sense is some recognition of the fact that there have been a lot of talk about, well, we've seen entry-level programming hiring coming down and all these kind of things. Like, look, you can't, we've been hanging on this dependency for decades, and it's time we now have the people. They're there. We've got them now. Are they at this level of eliteness? Are they stellar athletes? Would they be the star athlete on their team? No, but they could get there if we started to intentionally invest in them, upskill them, reskill them, take the people and train them. And we've gotten really far away from that. We keep trying to shortcut the system and bring in that talent. You just want to hire them from other countries. And that's not a good long-term strategy. I think, like I said, I think the H-1B program, as it was originally designed, is probably or should start to come to an end.
Thank you. And next question, what solution do you have to find blue collar workers?
Oh my goodness. I get asked this question so much. So one of the big things about this group of people is that they are not on the places that you would be on. So if you're an HR person or you're a professional and you're hanging on LinkedIn or you're going to certain job boards and you're posting things, that's not where these people hang out. You've got to go to these people. You've got to go find the people. They're going to be in other industries. How do you get your message in front of them in these other industries? Who is a great worker? If you look at your current labor pool, who are your best workers? What do you know about them? Where did they come from? And obviously a lot of people do this already. You ask them to ask their friends, or you hire companies like CoWorx and you say, you have a pool of these people, get in there and talk to these people and do they have friends? But networking inside that community is going to be very, very important. The big thing that I'm looking at right now is my concern is not necessarily just finding someone. It's going to be, how much are you willing to do to take a person who's okay and try to make them great? Take somebody who's maybe hasn't shown anything yet, but they could get there. There's always that aspect of companies going, look, it's going to drive my finances into the ground, doing all this training and everything. But you're going to you had to get used to that 2 or 3 years ago. You're really going to have to get used to that with where we're going in the next 3 to 4 years when that labor supply gets critically short. So I would say start to get really good at that now. Have a best-in-class training program. Have a best-in-class mentoring program. That's the kind of thing you want to do.
And doesn't the salary and the culture of the company really what's attract people too? Right?
I would call that table stakes. Like the salary has to be competitive. Doesn't need to be market leading. I think that's a great way to drive your company into bankruptcy. It's not about outpaying everyone because somebody else will just come along and outpay you. There has to be something more. So what more can you do? So I do agree that adding certain benefits to it, adding certain stake, like, hey, in our company, you did such good performance, you actually start to become part of our decision process of what products we want to do next. We're going to actually bring you in the room when we're starting to talk about our business planning. Empower people, show them that you're willing to invest in them and grow their career. That will get somebody to stay instead of taking another dollar. Not, this is a transactional job that I'm doing today and tomorrow I'll just do another one.
Okay. One more question. If there is still uncertainty due to the state of tariffs, is there any reprieve on the horizon that will positively impact our labor market?
No. So we have evidence, okay? Towards the end of last year, the cards all came out on the table. We all got to see it. So right at the end of last year, we were switching over into a new administration. There was a strong belief at the time that this would be a very pro-business administration. So hiring started to pick up. We actually saw some bursting in job postings, especially in the professional side. People were thinking this is going to get good. And you saw this optimism. I just saw a survey today. It was a CEO optimism. And then like up until February, it was like, man, we're feeling good. This year's going to be great. And then the tariffs hit in March. And all of that optimism just went completely out the window. So you have a great view of, in legal terms, they call it the but-for thing. So but for this happening, what else would explain where we are right now? So but for tariffs, had tariffs not happened, where would we be right now? And the belief is we'd be way better off. Uncertainty is such a prison. It literally gets it. As a CEO who's dealing with shareholders, and the shareholders are like, look, I want you to grow, but don't spend any money right now because I don't know where we are right now. So people really, really want to know what the future, immediate future is going to look like before they start adding headcount, because that's expensive. It could be a variable cost, but in a lot of these cases, it becomes part of just doing that business. And they're like, don't do that unless we're absolutely sure things are taking off. So what will happen is when you start to see people feeling good about things, they'll all feel good about it at the same time. So we're just waiting for that tipping point.
Wonderful. Ron, thank you so much. This was really very insightful. You always keep it moving fast, which I love that that pace you keep up. It's why you're so thin, I'm sure. But thank you very much. Very insightful, as always. Appreciate that. And everybody, we will be sending out, the recording is available, as well as Ron's deck, to anybody who registered for the meeting. So Ron, thank you so much. And we look forward to working with you again in the future.
Thank you so much, Barbara. Take care, everyone.
Thank you.